Hello, I use this video to help you understand how investing works once you're retired or nearing retirement. Um, People make this more complicated than it is. So I'm going to show you how this actually works, how people get their money to make money once they retire. And here we go. So there are only 4 places that a human being can put their money legitimately once they retire to make money, right? These are supposed to be buckets, so give me a break. Okay, you can put money in cash, you can put money in bonds, you can put money into stocks, and you can put money into real estate. Anything outside of that, you're getting, don't go there, it's unnecessary. So, we all know what cash is, right? That's money at a bank, CD, money market, savings account, checking. So the key is, you want this cash bucket filled up to a certain amount, the appropriate amount. Real estate, that would be equity you have in your house. Maybe a few of you have some rental properties, real estate. So really what we need to talk about here are bonds and stocks. These are the 2 vehicles that have worked over centuries. Let's talk about them. I think they're fascinating. I hope you do too. Okay, let's talk about bonds. Now, all a bond is it's a loan. It's a very simple financial instrument. So let's say that Coca-Cola is building a new bottling factory, and they say to you, all right, Dave, Dave, please loan us $10,000, and during the next 10 years, we're going to use your $10,000, and in the meantime, we're going to pay you a 3% interest rate. And at the end of the 10 years, we're going to give you the original 10,000 back. That's all a bond is. You are loaning money to somebody else. And then they pay you interest, and then you get the money back at the end. So if you look at bonds, right, in a diversified bond portfolio, there's lots and lots and lots and lots of loans all put together, right? That is a diversified portfolio of bonds. There's different kinds of bonds. There's corporate bonds, government bonds, municipal bonds. But basically, this is what's happening. They are all loans to certain entities where they pay you an interest rate for a certain amount of time. You are the bank. You are loaning money to them. Now, what's really interesting is what these bonds have returned. The return that they've had over time, it's been remarkably consistent. If you look in the 1940s or the 1950s or the 1990s, really, they've almost always returned around the same amount on average. It's not the same every year, but around the same amount. It's incredible. I don't know why. People ask me, how is that possible? And I say, I don't know. It's just how bonds work. It's just what people pay. So between now and the end of your life, bonds almost certainly, I can't guarantee this, but bonds will return between 2 and 4%. They've been doing it for a long time. That's what you can, it's kind of boring, honestly. Bonds are boring. The interest rates are a lot lower. They don't go up and down a lot, but that is a bond, a diversified bond portfolio. All right, let's go on to stocks. Stocks are so unbelievably misunderstood, but that's okay. That's why I'm here. So stocks, in its purest form, all a stock is you're buying a little piece of a company, and then if that company makes money, then you make money, right? So fundamentally, that's all a stock is. Now, yes, it's going up and down, but a lot of that has to do with greed and fear and speculation, and over the long run, companies grow, period. So what is absolutely fascinating to me is that stocks, even more so than bonds, have always returned around the same amount. This is crazy. 1960 to 1980, or 1940 to 1960, or 1995 to 2015, or 1880 to 1900. Stocks have always returned the same amount, almost to the same decimal point. The past 10 years, 20 years, 50 years, 100 years, almost the same return on average, almost to the decimal point. Do you want to guess what that is? What the percentage is? Are you guessing in your mind? All right, it's about 10%. So between now and the end of your life, if a stock portfolio does not return 10%, it's unprecedented. Can't guarantee anything, but it's unprecedented, okay? So whenever you invest in stocks, you're very simply investing in lots and lots and lots of stocks. When you hear somebody say diversification, you want to diversify money in stocks, you want to diversify money in, bonds, diversify money in stocks. And the other thing you need to realize is that whenever stocks go down, bonds go up because people get spooked and they move their money from one place to the other. Now, you're not going to do that because it's a bad idea, okay? We're going to be disciplined. We're going to be doing the right thing. But anyway, you have to realize that whenever stocks go down, bonds go up. They never both go down. Usually they're both going up. But this is very important to understand because whenever you hear somebody say, I'm investing in a diversified and balanced portfolio of stocks and bonds. I am investing in a diversified and balanced portfolio of stocks and bonds. That's all that means. That's what it means. It's incredibly effective. It almost sounds cliche that people invest that way. It's cliche because it's worked for an incredibly long amount of time. This is not aggressive. This is not speculative. This is just like basic, boring, balanced. Like, we're not trying to hit a home run here, right? We're just trying to, really what I'm aiming for is 6, 7, 8% on average over time. I've done this for 20 years and it's absolutely achievable. So that's kind of where we're coming from. I'm not trying to make you 20% a year, like, right? We're taking on way more risk when that happens. So anyway, okay, here we go. Now, the next step to this. So you have your money. And as we talked about before, the idea is as soon as you retire, you want to start taking out the money that the money is making. It's very simple, right? You've been growing your money, saving, growing. You're retired. As soon as you retire, the idea is you want to start spending the money immediately. The money that the money is making. We do not need this to continually grow. We're not going to be like all these people in the country that die with more money than they've ever had. I'm sure you know someone like that. Think about your parents or the older friends you have. They have this mentality that they have to save and save and save and save, or they're going to die broke on the street. It's this ingrained fear, and I'm trying to break it. And the easiest way to break it is find that perfect balance between spending too much and spending too little. I know it sounds crazy, but a lot of people don't spend enough. Anyway, so you're going to start taking out money on a monthly basis. Now, in the background, you don't know this is happening, but in the background, what I'm doing is each month I am taking money from what is working at the time. And what I mean by that is, let's say the stock market's down. Okay, like during COVID. During COVID, the market went down significantly. And bonds went up significantly. So during that time, during COVID, for the first few months, people were getting their checks from bonds. Now, things recovered really quickly from COVID, and now the market's just been going up, up, up for the past couple years. So for the past couple years, I've been sending money to my clients from stocks. So we're taking money from the right places at the right times, right? Diversified, balanced, taking money from the right places at the right times. Now, also understand, I think you already understand this, is that your portfolio is going to be going like this, right? It's not like the amount that we're giving you each month is an average. It's not dependent on what the markets are doing. So what that means is there are going to be times where you're going to be taking out money, you're going to be getting money from your portfolio, and you're going to say, Dave, this doesn't feel right. The market's going down, I'm taking money out, this is stupid, why would I do this? What I would say is, don't worry about it. We're not selling low, we're very simply taking money from something that's going up. We're never going to be forced into a situation where we have to sell something that's going down. So yes, and then again, there's going to be great times where you're taking your money out each month and it's still growing above and beyond what you're taking out, and you're going to say, this is great. Well, both ways happen, right? Sometimes you're taking it here, sometimes you're taking it there. Doesn't matter. We're looking at long-term averages. We cannot look at day-to-day volatility in the market. It is totally, it doesn't mean anything. It doesn't have any long-term effect on your financial future. So believe it or not, this is it. I mean, this is probably 80% of what you need to understand. This is 80% of how this works, maybe 85. So again, I don't want you to make this more complicated than it is. Investing your money, very powerful. We're using the right instruments in the right proportions in the right ways. And this is the way to invest successfully in retirement. I hope that helped.